Hi everyone, Sanjeev here. Today I thought I'll do one of our client case study who have bought 5 properties in last close to 3 years time. This will also give someone not sure what to expect in the property world. So again, this case will help you to understand what one can expect or what can happen and how it can help someone life how to play this game. So let's get into this case study. So this case study is of one of our client. His name is Tom. He is based in Sydney. When he started with us, he already had 2 properties, one owner occupied and another investment property in New South Wales, which is in Central Coast. And then he came to us. I think before signing with us, he has already interviewed a lot of other buyer agents and finally decided to work with us. And so yeah, that's the background. He works as a senior executive in one of the multimedia firms. And so I think yeah, so let's get into his what sort of properties he bought. Let's get into this. So this is the first property we bought back in like pretty much in June, I would say in 2021. So this was the first property we bought in South Australia, in pretty much in Adelaide for as you can see 398. The cash invested was 20% deposit, cost and buyer agent fee around 110K. Currently, it is renting for 450 per week, which is on a lower side because the similar properties are renting for 500 to 510 per week in the current market. The current value of this property is now around 580K, which is conservative. So capital growth in last almost 33 months is around 182K. And when we bought this property, it was renting for around 400 per week, more or less. So you can see what can happen in less than 3 years. Good capital growth, good rent, and again, he can easily increase the rent to 500. So that's one property. And then immediately after this one, next month we bought another property. This was in New South Wales Regional. We bought this one around for 420K, and the cash invested was 115K, and the current rent is 520 per week. And then the value of this property at the moment is approximately 560K. Again, that is conservative. And the capital growth gained over this last 32 months is around 140K. So again, a good growth. As you can see in the last property also, the cash on cash and is almost more than 100%, and similarly for the second property as well. Now coming back to the third property, this one again we bought back immediately in a row. Actually, he was cashed up that time and he bought. So this property is again in New South Wales Regional. We bought it for 374 and the cash invested was around 105K, and currently it's renting for 450 per week and the current value is 500K. Now this property is a development potential. You can build another house in the back, you can subdivide, plus you can easily build a granny flat. It's 1000 square meter in land size. So again, capital growth on this property is around 126K in last 30 months. Again, cash on cash, if you look at the returns, it's more than 100% in last in this 2.5 3 years time, right? So this is the fourth property we bought in Queensland Regional. We bought this for 357. Cash invested was 100K, including all cost, buyer agent fee. Current rent on this property is quite good, 540 per week, and the current value of this property is around 500K. So again, capital growth on this property they have gained is 143, and this is like just in 25 months because we bought this one in January 22 and of course it's settled in February. So again, so this was the fourth property, and this was the fifth property we bought last year in 23 January. And pretty much if you see last 15 months, because we're recording this in pretty much end of March in 24. So I think again we bought for 525K. The cash invested was again 140K, and the current rent on this property is 600 per week. The current value is again conservatively 680K. So the capital growth on this is quite significant, 155K in just over 15 months. So again, shows like how one can make buying properties, and they all houses on decent land size in really good growth areas, good rental yield. So now the result for Tom in around 33 months, which is less than 3 years time, the this is just the 5 property he's bought with us, because I'm not putting his own owner occupied or the investment property. He was already owning it. So the portfolio, the current market value for these 5 properties is around 2.820, around say 2.8 mil, and the capital gain he has already gained so far in 33 months across these 5 properties. And the 33 month is the first property, and then so you can see average, like he has gained over these 5 properties is 626k, so which is like literally 130k per property, right? So yeah, I think again the total cash invested across these 5 properties is 565. So if you look at again, cash on cash return, he has already got more than 100% on his cash on cash return, right? Just even, and this in just last less than 3 years. Now, of course, the properties are growing; they will continue to grow. Rents will continue to go up, right? So again, shows the power of investing. So in case you're thinking, or you're a little fearful and not sure what can you gain out of investing, again, I'm not saying that you will get same result, but this is the potential. And I'm not, this case study is not a 10-20 year ago. It's literally last 3 years again, as you can see, right? They have started and they have gained so much. So now this is like pretty much which I'm gonna go in a spreadsheet soon, but this is the snapshot of his portfolio across these 5 properties. As you can see, the LVR, loan to value ratio, is now almost 58%. So again, he has got good, almost the available equity, because he bought all his properties with 80% LVR. You can see the around is 626k, right? Now, because all these gains, of course, he can take out this money and go and invest further in more properties. So right now he has got these 5 properties and another 2 properties which already he had earlier starting the journey with us. So and like right now these properties, when we bought it, of course the rate of interest was quite low, so these properties were positive cash flow that time. But right now, if you see here with the current, just if you do interest only repayment, he's around $10,682 negative in a year across his whole 5 properties, right? And given he's paying a principal and interest, he's around $29,000 out of pocket. But of course, 10,600 is what he's negative, which he's actually losing, and then rest $19,000 is going towards his principal, right? Which is actually he's paying towards his property. So, but now again with this 10,600 loss, of course he's getting those, getting the tax benefits, which again, with his tax income bracket, he's getting his 40 cents back, right? So $4,000 he's getting back. And if you include the depreciation and all, which some of these property has really good depreciation, like especially the last one, which is in Perth, right? They're getting all the good depreciation in those, right? So pretty much I would say he's getting almost this money back from the ATO, right? So, and then, so you can, right now their negative rate of interest are quite high, but of course, the rents are also going up. And given he has done well with especially the first property, and other few properties, he could have all, he can almost increase his rent across his 5 properties by $100. So again, now if you increase $100 across all your 5 properties, which he can, because he's not going aggressive and looking after the tenants also, right? But if he can charge $100 across his 5 properties, you can see that gives him $5,000 pretty much, right? So yeah, I would say right now it's a neutral portfolio across these 5 properties for him. And what it also shows that if he holds his properties, and in this one we assuming the capital growth would be 6% year on year, right? So in Australia, generally any good properties you buy, you look across, you can expect to have 6 to 8, 9% capital growth every year. And we have just put 6% year on year. So you can see even he stop investing and doesn't do anything, these properties in 10 years time by 34 will be worth $5 million. So you see, another $2.2 million over 10 years, he don't have to do anything. And that is very conservative number. at 6% capital growth. As you can see, these properties have done so well. The capital growth is quite significantly, right? Significant on these properties. But this shows again why I'm sharing this, because couple of things. A lot of people think, hey, I talk to a lot of people and they are in their late 30, early 40, late 40, and they think I'm already late to the property world. But guess what? Tom, when he started working with us, he was 58, right? And at 58, he has gone aggressively and bought 5 properties. Of course, he had the cash and all, but now like in just 3 years time, you can see what one can do it. So I think, yeah, if you're in late 30s, early 40, late 40, even you're in your 50s, right? Hey, it's never late. And this clearly shows what one can achieve. But at the same time, see, you may think, oh, I don't have this kind of money, because of course you can see the cash invested he has done is 570K, right? But even you buy 1 or 2 of these properties, think about what it can do to your portfolio. A lot of people are using their super money to invest in property, self-managed super fund, right? So again, how much you have in your super? Maybe there's enough money, right? Next, let's see what Tom has to say. Like after this one, I'll get into the spreadsheet also, but let's see what Tom has to say. I mean, this is like, generally after, I think I did a podcast with Tom after he bought his 4th property, and we were planning to buy his 5th property with us. So I think let's see what Tom has to say.
The first purchase sight unseen was a challenge, to put it nicely. It was a very difficult moment, making a decision to buy a property and lock yourself in for something you hadn't physically seen. We did video walkthroughs and did all the due diligence, which was fantastic. We had all the reports, all the data. Everything looked right. I ran my spreadsheet, something I do a lot of. And even then, it was easy to procrastinate and find reasons not to. And it was just one of those challenges, sight unseen, buying a property. But once we pushed the button on the first one, it was a sense of relief, and I knew that I was doing the right thing. I felt confident, and that's why there were 2 more in fairly quick succession straight after it. Again, both I had not seen. It was via video call, research, due diligence, and we pushed the button.
So why I was sharing this one, because a lot of people fear, like, I'm buying properties interstate, sight unseen, and we all get fear, but that's what is required now. Like if you want to achieve, if you have a good process, people are doing that, and it's not like a gambling or playing it blind. It's more of a process, right? Now you can use a buyer agent or do yourself, right? But most likely one has to need to have a good process there, right? So again, you decide, right? Like that, like of course Tom partnered with us, and in 3 months actually, the first 3 properties we bought in a row, right? And then the next 4th one was after pretty much 6 months of buying the after 3 properties, and then the 5th one was pretty much after a year of buying the 4th property, right? So again, partnering can help if that's what if is required, right? But if you can do yourself, go for it, right? Nothing wrong in that. But I think that's what it shows. Like again, having a partner or a good process can fast track and most importantly take action, right? So now let's get into the next one. Sorry. Now we have got this whole Tom interview. It's a 40 minutes interview with Tom. So I think either you can watch on our YouTube channel or you can go on our website investorsdream.com.au, and then there is something called podcast section, and in that one you can search and you can watch full Tom interview where he has shared a lot of his insights, his fear, and still how he managed to take action, right? So I'm sure it will inspire and it will give you a good context, but at the same time these numbers are real, right? Like and I'm sure like making 600 plus 600K, right? Like in less than 3 years, it's a lot of money, right? And these are real capital and and happening, and so I think just think about it. Now let's get into the spreadsheet section. So now what I want to share is this spreadsheet which we work with our clients, so that it shows like, so what we have done is, this is a property portfolio tracker for us. So if you see here, what we have done is, like, for each property it tracks how much cash flow and all, right, like, and capital, like what's happening in terms of the return on investment. Everything is tracked. So this is something we use for our clients. So let's get into the full this thing. And so one thing I want to highlight, because a lot of people think that what if there's a lot of, so what we have done is, for the rental side of thing, all these properties are in an area where the vacancy rate is 1% or even less than 1%, right? Which means very high rental demand, and you will not have any vacancies, right? So what means is, like, at the same time, what we have done for all these 5 properties, we have calculated the rent at 50 weeks only. So still you have 2 weeks of rent in case there is any expenses comes for the property, while for maintenance we have just put $500, right? So again, 2 weeks of rent per property for 5 properties, right? That is a lot of buffer in case you have sometime a hot water system can break and it can cost you $2,000, for example, right? So you have enough buffer in these cash flow inbuilt. So let's get into now the portfolio part, right, where we have excluded any owner occupied or self-managed purchases. So like, this shows again, market value of all these 5 properties is around 2.8 million, and the equity is 626, cash invested 570k, and at 6%, you can see, like, in by 34, the same portfolio, even Tom stopped investing at just 6% capital growth, right? In 10 years, the same portfolio will be worth 5 million, and the rent would, at 4% growth, would be around, so right now he is getting a total rent of 2,560 per week across these 5 properties, but with just 4% growth, you can see the rent will be around $3,800, right? So again, because he's paying principal and interest, his principal is also reducing. So again, even someone goes and says, what, I'll just keep it interest only, I'll not pay principal. Look what can happen, right, with all the compounding growth for these properties. So again, very powerful. So you can see here, right? So this is his 10,000 negative. As I said in my previous slide, again, if you remove, because with the negative gearing of $10,000, this is actual loss across the 5 properties. And if he add the depreciation also, pretty much he will get back his $10,000 from the ATO, right? And then 29 is including the principal. So, which again he's paying, because right now he's paying principal interest. And then these ones shows in case the rate of interest goes to 7% or something. So this is calculated with some buffer with any rate increases and all, right, rate rises. So, but this is the current value with the current loan repayments and all, right? So these are the 2 things. So yeah, so pretty much hope this helps. But yeah, I think this is the tracker we use, and you can see we have actually, the buffer investment loan rate of interest we have put is 6.8, but one can change. And by 34 in 10 years time, same thing is doubling up, right, to almost 5.6 million. So that's again shows the power of compounding growth. So now this is across 5 properties, but even you just buy a couple of properties, or maybe 1 property every 2 years time. So think about it, in someone buy 5 property in 10 years time is still, and especially if someone can start at young age, in their early 30s or in their 20s. I have got one team member, he has got 3 investment property as he is only 25. So of course he has got very bright financial future, right, given he has started so early and using the compounding effect of investment. So, but if someone start in the 30s also, or even in their 40s, right, still by 50 they will have good 5-6 properties which will help them to retire earlier, right? So again, it shows the power of investing. That's all. So hope you got some good insights and inspiration from this case